morning. How are you this morning? It feels like I woke up 10 minutes ago, but luckily I did not. But I did wake up very, very late this morning because of I went to bed late last night. So one of those lessons. Go to bed earlier. When my alarm goes off and it says, listen, but it's 10 o'clock, you need to go to sleep. And I'm like, I still need to do this and this and this and this. And then I keep on going. And before you know it, it's after 12. And then I battle to get up in the morning. But here I am, just in time. And I've got some fresh tea. I hope you've got something very nice on this cold morning. And that you will enjoy this morning session with me. I'm really looking forward to sort of sharing some big mistakes that I've made myself, but also then, what I've seen other people make, which is quite an interesting one as well. So I want to get into that. I've got another session after this with a group of advisors in Rustenburg and surrounds. So looking forward to that. That's a very quick 10-minute session that I'm going to do. So very, very excited about that. I don't really know much people, on that side of the world. So really looking forward to that. Alrighty, good morning, Casper. Welcome. Very nice to have you with us. Kobus, good morning. Raymond says good morning, guys. Neil Strydom, goeiemorgen. Denise and Malcolm says 443 good mornings. Yes, 450 is around the bend. I can't wait for us to hit 450, and then 500 is the next goal. And in fact, the real goal is 1,000 subscribers. That's where we are at the moment. So we are going for 1,000 subscribers. So yeah, if you're getting value from this, please tell others. If you haven't subscribed yet, please consider subscribing. I trust that we bring a lot of value to the table, and we will continue to do so. There's lots of ideas and things in the pipeline that we're going to do. So please do that. Johan Vosloo, geluk. Like it was a good one yesterday. I really enjoyed the part where you were talking to your system and giving voice commands, and it sort of did the filtering. So it was really amazing. And I know it's still in concept that you're working on it, but it was really amazing. It was mind-blowing. I really loved it. So well done. Really enjoyed that. Razan, good morning. Yeah, good to be back. I see you've got 2 coffees there. So that's good. Yes, Malcolm also says, nice one yesterday. To Johan, Renee, good morning. Tinus, goeiemorgen. There we go. Just saying thank you. Let me just scroll down. Love the haircut. Thank you very much. It is my wife that is this talented. We didn't know. It was a big risk, but it turned out to be a good investment. So high risk, high return. How's that? So, Renate, good morning over on LinkedIn. And we've got Pieter Strydom. Goeiemorgen, Pieter. Yes, I also saw you subscribe to the channel yesterday. Thank you very much for that. I appreciate it. Bye, welcome. Bongi, good morning. Nice to have you back. And then, we've got Kevin and Hatsiandi. I haven't seen you here for quite a while. Martina, good morning. Rustenburg is your hometown. Yeah, that's right. I remember now. Good stuff. Chart, good morning. And Jaco Roots, good morning. Goeiemorgen. People keep on coming in. So good morning, Cindy. And Ravi, good to have you back. Stephen, good morning. Alrighty. So, let me get sort of into the show. Please remember to give us some love, go like it. Even the previous videos, if you maybe didn't like the Brian Parsley video, not that you didn't like it, but you didn't hit the like button, you can still go and do so. So please do that, even on LinkedIn. If you are rewatching videos there, please hit the like button and leave a comment, etc., because that helps a lot. On LinkedIn, shares and likes doesn't really do that much. But if you comment, that is really where it's at. On LinkedIn and on YouTube, all of that matters. So you want to hit that like button, you want to leave a comment, please do that and interact with one another. This is really about the community, and I want you to build relationships and do all the good stuff. Make use of this opportunity. This isn't about just me sitting here and giving you some entertainment sometimes and some valuable information and all that kind of stuff. So please, make use of this and build those relationships. Alrighty, so thank you very much. I've really received a ton of registrations yesterday. I still need to go and check where they all came from, whether they all came from the email I sent or from the WhatsApp and the video and that, but I received a lot of registrations yesterday. So to every single person, I can't name you by name, but for everybody that registered, thank you very much for that. If you still want to register, you can just go to francodutoit.co.za/online refresher. We're going to touch on a lot of stuff. And if you go to that link, you will find all the information. Like any question you've got, I can promise you I answered it. It's on that page. So please go have a look. You can see exactly what we're going to cover, how long it's going to be, when it is. And if you should attend or not, I even say who should be attending. So if you're not sure if it's you, go check it out and then make your decision based on that. And if you still don't know, get in contact via WhatsApp. I will gladly have a chat with you. Then just a last reminder of Brian Parsley, his generous offer where you can enroll in his Mastering Strategic Communication course, where if you use the special code Francois when you are in the checkout, then the price goes from $997 to R0 and $0 exactly. So please make use of that. I want to ask Brian today how many people have registered. So really looking forward to it. This video of his is doing extremely well. So this interview that we had was brought a lot of value to the table. So if you still want to make use of it, please do that. It expires on Sunday. So you can't use the code after Sunday, which means you'll have to purchase it. If you're in. So you won't lose access to the course after Sunday, but to enroll in the course, you've only got until Sunday. So make use of this massive, massive opportunity. Alrighty, so that is that. So let's get into today. And I just want to sort of at the onset say that the things I'm going to focus on, so these, there are, if I really need to get into the mistakes that we make, then, 5 is not going to be enough. It may be 50 mistakes. But today I really want to focus on the technical financial planning side. Yesterday I had again, and there's a lot of realizations that I'm getting. So tomorrow I'm going to be talking about the 5 things that we should already be focusing on, so that not only do we position ourselves for the recovery, but for the future of where we're headed. Yesterday, I spoke to Kate Holmes on my podcast, and which is called Propulsion, for those of you that don't know yet. So I spoke with her, so we still need to edit the episode and check it and all of it before it will be released. But that'll be the next episode that's released on Propulsion. And we, one of the questions that we got into was about, like, where are we headed? What are we seeing? And also, if you listen to her story about why she started a business and what led to that at the end of the day, it's like these things are happening and I don't know if we're noticing them. So I came up with 5 things that I think we should be focusing on. So that's tomorrow. Today I want to focus on the biggest mistakes, and these are very much related to technical financial planning. So really, like, the stuff that we do when we do the numbers in the financial planning kind of stuff. So this isn't about habits or about what you do in your business or you don't do, etc. This is just about when we work with clients and their finances, what are some of the biggest mistakes that I've made and that I've seen so many other advisors make as well. So it's not the number one biggest mistake, but number 1 on the list. Okay, so but not because it's the biggest one, it's just the first one. So yeah, I could confuse myself. Anyway, it is the unintended mistake. And this the bad thing about this for me is that so many people will criticize others when they make these unintended mistakes. And we will go like, oh no, like, like almost you want to use, like, they are not honest, they are not ethical, they're just looking after themselves. And I've had quite a number of experiences where that was not the case. So I want to give you like a real life example that I was involved in. And I was still at Liberty and I was a manager there. And I used to visit advisors, I called it solo calls. So we would go and visit them. And, without the consultant going with or anything like that. And on this particular day, I was at ABSA, and the guys that we really looked at looked after was on one floor, and then there were some other guys on another floor. And because I knew the bankers quite well, one of them came to me and said, Francois, please can you come and sit with this client and just talk to this client because he is very unhappy about a Liberty investment. And I said, okay, no, I'll do that. And it was a very old man. And, it wasn't a big amount. It was about 300,000, but for him, it was everything that he got. And I sat with him and I asked, like, what are his concerns? And he said to me, Francois, I asked for this money to be invested in money market, but it's in this product. And I don't know, I'm not getting any growth, but it's in money market. So obviously I had to go back and look at it and all of that. And then sort of a few things there. And this has got nothing to do with Liberty. I shouldn't even have mentioned their name. It's got nothing to do with Liberty. This was when I sat down with the advisor, because I knew the advisor as well. So I sat with the advisor and we went through sort of what did they do. And what really happened, yes, he said, yes, the client said he wanted to be in money market. And some of you, when I go through what happened, you're going to say like, ja, maar regtig. But I'm going to get to the punchline at the end and tell you why I think so many of us are making these unintended mistakes. Anyway, so it's also the reason why I believe all advisors are good. They are good-hearted. The intention is pure. There's certain things that is just getting in the way. But anyway, so what happened was I looked at this. So this was a second-hand policy, which means that the money was available. It was invested into a money market fund, the only money market fund that was available on this platform. And then sort of if you then go into the detail, the annual management fee on that product was 1.2%. If you invested into money markets, so 1.2%. And then there's obviously ongoing advice fees of 0.5%. So you start adding all these things up and there's not much left. I mean, at that stage, I think the money market in the bank gave like 5% or 5.5% per annum. So you take away, the half of the money is gone. And then the other unintended consequence, or I mean, just the way that this works is that whenever you withdraw from that and there was growth, and if you're in money market, there would be growth, then there's also some capital gains tax implications. Now, luckily, it was a small amount. So to get over, I can't remember what the limit was, what the annual exclusion was at that stage. But, chances were that you would be liable for capital gains tax. So it's all these things. But when I sat down with the advisor and we were talking about this and he took me through his thought process and why, and I could see like he just didn't get what was going on. And it's maybe it is an indictment on the knowledge levels. But at the end of the day, I could see in his eyes and I could see in the whole way that he was dealing with this, that in his heart, he thought that he did exactly what the client wanted and that he did the right thing. And that, and I always say a relationship needs to be mutually beneficial. So it's got to be worth it for the client, but also for you. So obviously in his mind, he was thinking, well, the money's available, it's in money market, and there you go. But what he didn't understand was the tax implications. He didn't understand the fee implications. Because if you compare that to putting your money market, that money into a money market at the bank, maybe the annual fee was 0.4%. Here we're looking at close to 2% per annum because of the ongoing advice fees and those things as well. And there was an upfront fee. I can't remember what it was, but he did take an upfront fee as well. Because it was in his mind a normal investment and I could do it here. And maybe it was intentional, maybe it was not. But from what I could see, it was not intentional. It was really just a lack of knowledge. And the biggest mistake that we make here sometimes is that we focus on matching needs and product features. And that is a big, big, big mistake. There are so many things around that because you can have 3 different products that all meet the needs, but one of them is much better suited because of costs, because of tax treatment, etc. So, and what maybe goes for one client, for the next client, the other product is better. So it's not about, if we were just matching features and benefits to needs, that is where you really tread a very, very dangerous line. But here I saw this. This was an unintended mistake. It was a huge mistake. It was massive. I mean, it turned into a complaint. But it is not intentional. It is not that this advisor was like it's just about himself and doesn't care about. No, not at all. It was a serious unintended mistake. So that for me is number one. Those are the ones that we make that we don't even know we make them, and it wasn't our intention to cause any harm or loss or anything like that. We just believed in our hearts that we're doing the right thing. But the problem here is that there's knowledge that is not there that should be. All right, so number 2 is considering a need in isolation. Now, this I've also seen, and this is something that I've learned quite well. When you look at the way that we are taught, even if you do your CFP, I mean, I've been thinking about this a lot now this last week. And I mean, I think that if you're in this business, you should get your CFP, definitely, because that is part of what would be expected from anyone to have that kind of knowledge. But it is still very much focused on product as well. Yes, there's a lot of legislation, a lot of tax and, other concepts and things that you learn. But at the end of the day, it is still to get to a recommendation. And that recommendation still involves product, and there's nothing wrong with that. That's not what I'm saying. But the one thing that you are being taught from the time that you start in this business is that holistic financial planning is the way to go, and that's the thing. And it's not really necessarily said like that. I said it yesterday to Kate in the podcast as well. I said to her, it's not like it's said like this, but the way we receive the message that holistic means whenever I look at something, I need to look at. So if you come to me, for example, and say, listen, I've bought a house. The bank insists on life cover to cover the bond. then usually the response, if you're a CFP, that's where I was back in the day, is to say, well, no, it's good, but we need to look at everything because we do holistic financial planning. So you need to look at everything. And that's a huge, huge, huge mistake I came to learn, because why? It is so overwhelming for the client. And number one, that is not what they want right now. All they thinking is like, I want my bond approved. I want to move into my house. So the biggest thing that I learned here is that, well, just focus on that one need. But there's always a but. So now that need, the problem is that often people just look at that and say, oh, the bond is for R1 million. So there's life cover for R1 million. Thank you very much. That was a nice sale for me, and that was an easy one to do. But if you go then, just think about that for a little bit. I can look at that single need holistically without going, oh, I need to look at your retirement planning and your estate planning. And yes, all those things are important because what you're doing right now has a fundamental impact on all of that. But right now, that's not your concern. So how can I look at that need holistically? Well, very simply is to say, well, I need to ask some questions and get a better understanding. So to say, so are you going to cede this policy to the bank? Yes, I am. Okay, so if that's going to be a security session or a collateral session, we need to know that that means that that policy is going to be subject to executors' fees. So that means that if it's for R1 million, we can't make it for R1 million. We need to add on executors' fees. It's got to be 1.4 whatever, 1,040,000 whatever thousand. And that doesn't seem like much. But 40,000, you go to a 10 million property, it becomes 400,000. So it does make a big difference, if we don't take those things into consideration. And then also to tell the client, listen, we're going to look at this. We need to get together, but let's get you into your house. When you're in, I'll come and visit. Show me your house. I want to celebrate with you. But then we also need to consider your estate planning. We also need to really look at your retirement planning, and it becomes a journey. So holistic financial planning is a journey. It is not an event. It is not what we do every single time when we work with someone in the way that we perceive this to be. Just put yourself into that client's shoes. It's very, very overwhelming. But so if we consider a need in isolation, look at that single need then, if you will. I know that's a swear word, but that single need holistically, and understand what is being touched if we sort out this one need right now. What else is touched, and what must I look at now to be able to cover yourself from that, and just to give solid advice. I think that's obviously important. Then this is going to maybe open up a little bit of debate, but specialization. And I've often said, like, I think it was episode 10 or something where we spoke about, should you niche or should you not? So, because it's about focus and it's about specialization. But that in itself may be a mistake. So, and I'll tell you from what perspective. So this is more from the FSP's perspective than it is from you as the financial advisor's perspective, or it doesn't matter what it is you do, if you're an accountant or you're in tax or whatever, and you personally love to work with, let's say, investments. If you like that, it's good. You should focus on that. And I've seen this so many times. Like, we work with advisors, they only do investments. That's it. Whether it's post-retirement, pre-retirement, or they don't do estate planning, they don't do risk planning, nothing, because that's not for us. I hate the life policy, simply because of whatever their reasons are. My challenge to anybody that's just focusing on that is that, it's obviously fine if you make it clear to the client to say, we are not going to look at your will, we are not going to look at your estate planning. You should find someone else. And the question is, are you happy to open that door for someone else? Because clients do prefer to work with one person. I don't know if you're the same, but I prefer to, if one person can do everything for me, and you can just look at it, where if you've got a problem, you always phone that one person at that company. You don't want to deal with the person that actually deals with it. You just want someone that you trust to sort this out for you. So from that point of view, I think that's where the danger comes. If you say, I only deal with investments, that's cool. But someone else in your FSP or in your business should be dealing with the risk and the estate planning and the wills and those kind of things. Because for me, if you are running investments for a client or managing investments or whatever it is you're doing for them, that is a fundamental part of their estate. And how do we deal with those? So we can't ignore it. We can't just be building assets under management and then not have a plan for when that person passes away. So that is extremely important. So all of this may mean that there's some blind spots, and this is not applicable to everybody, but this may be applicable to you. And if it is, it's just something to consider, and at least you considered it. Because, one of the things that I sort of see my job as is to challenge the way that we do things, to make you think about the way that you do things. That's my job. Nobody else is doing it. Maybe your spouse is if you're lucky, but otherwise nobody's really challenging you. Everybody just want to keep you happy. I'm here to challenge you and make you think about things. And if the answer is no, we're doing it the right way and I'm sticking to this, at least you considered it. I think I've said this a couple of times on this show. Then another big one for me, because I love tax, but a big one that I see, a big mistake that I see a lot of advisors make when they're doing the analysis, so whether it's the paraplanner or whether it's you yourself or your sister, whoever is preparing the F&A, is that when you use that, you use marginal tax rates, because many of the systems will not calculate the actual tax rate of a client. You need to define what that would be. Or they look at the income in isolation and then they just apply the tax tables to that income in isolation. But if there's multiple incomes, it's usually not that. So what we do is we use marginal tax rates. And that is quite a huge mistake, in my opinion, because I've seen, like we do, if you look at somebody that earns 550,000 Rand, you're looking at a 36% marginal tax rate roughly. I'm not sure now with the new tables if I may be out now. I didn't check this now. But let's say you're around a 36% marginal tax rate. If you calculate the tax on that amount and you look at what the tax payable is and you calculate that as a percentage of the 550,000, then the net effective tax rate is only 23%. That's a 13% difference. Why is that? Because the tables on the first 80,000 you don't pay tax. Then on the next, like over 200,000, there you pay 18%. Then, so you don't pay 36% from Rand 1. But what we're doing is if we're inputting into the system that use 36%, because that's the easiest thing, you just look at what is the total income, what does the table say? Oh, you fit in there, and then that's what we use. But the problem with that is, as I said, is that now suddenly you're on a 36 instead of a 23%. That is 50% more. So you are inflating the shortfalls from that perspective. And, I know it's a worst case scenario, so you can go with that. But again, if you're doing risk planning, I've got a big issue with that. If you're doing investment planning, I don't have such a big issue with that. But if you are doing risk planning or estate planning, I've got a big issue with that, because you're going to sell a bigger policy that is unnecessary, number one. And number two is that premium should have gone into doing something else, either paying off debt, or it should have gone to retirement planning or whatever they wanted to do with that. But it shouldn't be going to a risk policy, if it's not needed. So this is a huge thing that I see. And then also, there are a lot of other things if you think about full-fund tax and, all the exemptions and all of that. So where does that come in? Because that does make a fundamental difference, And for some people who's young and you're doing goals-based financial planning, maybe not so much an issue. But for some people, it is definitely a big issue. So using marginal tax rates is not the right way to go, particularly as far as risk and estate planning is concerned. All right. Then my all-time favorite. I've actually got something that I've termed the golden rule. Okay, and I'm sure I'm not the only person with a golden rule. But let me give you an example. So if I say the focus is on saving tax, that is your entry point into the discussion. So from two sides, either you approach the client and say, listen, I want to save you tax, so let's do this. And or the client comes to you and says, Francois, geez, I'm paying too much tax. I don't want to pay the government a cent. I don't want to do this, because I get that a lot. And the moment that you make tax the objective, saving tax or not paying tax the objective of the plan, or the primary objective of the plan, then again you are treading on dangerous water. So let me give you an example here. So the one, let me start off with the one that I get a lot in our tax practice, is that people have, let's say, a second property that they rent out. They've got a bond on it. Now over time they pay it off, because sometimes they pay the repayment, and then they also take the rental income and pay it in there. So they tend to pay it off quite quickly. Or it just gets to that point where they've actually paid it off. Then what happens is, because you are renting it out, you can deduct the interest on that home loan against the rental income to reduce it. So if you are, let's say you receive 100,000 Rand in rental income, and now the interest is 100,000, for example, for the year, then your taxable income will be 0 and no tax is payable. But as you pay it off, you start making a profit. Now, I don't know about you, but if you are into business and having a rental property is being in a business, you are in there to make a profit. But anyway, so people don't want to pay tax. So now they get to a situation where the property becomes profitable, so now there's tax payable, and because the tax is not deducted when you receive the rental income, you need to pay provisional tax, and then you get this lovely bill every 6 months, and people go like, no, I don't want to pay this tax. So then I get this question. So, should I increase my bond again so that I don't pay tax? And then I go like, yeah, no, you can do that. But before you do, let's just quickly talk about this. So what happens is, let's say you earn 100,000 in rental income. Let's just disregard everything else. And let's say your maximum tax rate already. So let's say your total income is above 1.5 whatever million. So that means that any rental income, any profit from that rental income will be taxed at 45%. So 100,000 means 45,000 in tax. So meaning that you've got 55,000 rand left. Now that does hurt. I mean, that's half the money gone. Okay, but you've got 55,000 rand in your bank account or in your pocket or wherever you keep it. And that's great. If we now increase your bond to, let's say the interest now equals or whatever amount it may be, but let's just say we do it to equal your rental income. So now you get 100,000, we deduct the interest of 100,000, so you're paying 0% tax. But where is that 100,000 going? It's going to the bank. So now the bank gets all the full 100,000, So there you go. So now, great, you're not paying tax, but you also don't have a cent left at the end of the year or the end of the month. And that is what people are not really getting. So it's important that if the whole purpose was not to pay tax, we may have thought like, well, that's a great idea. Yes, increase that. Or this is where you get this advice, go buy a big car, do this, do. No, it's about cash flow. It's about money flowing out of your account. That's what it's about. Because the problem is, whenever I want to save tax, I've got to spend money. There's a few things that are exempt, and that's great, and we should look at that. But when it comes to deductions, if I deduct, it means I needed to spend money. So if I spend 10,000 rand, the maximum, depending on where I am, and you just saw, like, if you're a 36% taxpayer, if I work it out on 550, your effective rate is 23%. So that means if I spend an additional 10,000 rand, I'm only going to get 2,300 rand back in tax. It's not a good investment. So unless you have to spend that money, and unless there's a reason and you were going to spend this money anyway, then we can look at it, how can you structure it to be tax efficient? But to incur new expenses in order to do that is absolutely ludicrous. So it's a cash flow consideration. It's not a tax consideration. And often tax is just the cost of achieving the goal that you're actually after. So the other thing is obviously doing a retirement annuity, which is great. You can do a retirement annuity. And the unintended consequence of that is that at least it stays your money and you're saving. But here's my problem again with that. We don't know whether you are saving enough. We don't know whether it should be going to a retirement annuity, because I don't know how you're planning to live your retirement. How does the client even know how they want to live their retirement yet? So we put all the money into a retirement annuity where maybe it should have gone to a unit trust. Maybe they should have invested more into their own business. Maybe they rather should have paid off other things, So it's still, even though a RA it's a better option than saying increasing your bond or buying a big car, it is still not necessarily the right thing to do. And that's what I'm saying. And so my golden rule is that we need to focus on the objectives of the client. What are they trying to achieve? And tax shouldn't be the main thing there. Tax is always secondary to what we are actually trying to achieve. And then once we know what we want to achieve, we want to try and do that as tax efficiently as possible. Cool beans. So that is my 5 mistakes. I don't know. Is there any other mistakes that you feel, that you see people make, or maybe that you felt, or maybe a lesson that you learned, that you felt like it was, that was a big one. So, you're welcome to share that with me. And let me see quickly. Good morning, Gomotso and Slanganani and Francis. Arun, Justin, Neil Phillips, good morning. Kevin says maybe it's endowment subject to 30% tax on interest. Yes, but here's the thing again. So how we are taught is that you look at an endowment, or when you look at the guy's tax rate or the client's tax rate, And as soon as it's more than 30%, then an endowment is a good, no, it's not. You need to look at the effective rate of that client before it is. And then the second thing that you need to consider when it comes to endowments are the fees, because I know there are much cheaper endowments available now, but often those endowment fees will just obliterate any tax saving or any tax benefit that you got through the fees. So an endowment is really, like in the rare case, it's the right thing to do, but it is definitely, when it is the right thing to do, it can be very beneficial. If you think about trusts are taxed at 28%. 28%. There's no sliding scale, no nothing. In an endowment, a trust pays tax at 28% because it's taxed in the corporate fund. In their own capacity, if they leave that money there, it's at 45%. So if they were going to distribute it to beneficiaries, then it's another story. One would need to have a look at it. But if that money was to remain in the trust, an endowment can be a very, very good thing, as long as they don't need liquidity. But anyway, so let me not get into that. That's the whole thing. Good morning, Sureta. That was a good question, Kevin. Thank you. During the lockdown, the diversified revenue stream from different business lines has carried us through. Yes, that is very important. Alrighty. Guys, so that is my story. If there is nothing else that you would want to add to this, then I'm going to say thank you very much. I deeply appreciate you, and thank you for being with me this morning. I will see you back tomorrow morning, where we'll talk about the 5 things that we should be focused on to be moving forward. Alrighty, have a good one. Appreciate you. Stay well, stay safe. I'll see you soon.